Hello, everybody. Hope everyone's doing well. Raza Khan here. Very excited that you could join us for this very special end of the year update. We're going to be talking about a lot of great things, and we're very happy that you could join us. We're waiting for people to kind of trickle in, and we normally take a couple of minutes to kick this off. So I'm going to put myself on mute and turn off my camera, and I'll be back in exactly 2 minutes and we will kick it off. Thank you very much. Very excited to be here with you this evening and share everything I got to share. I'll see you soon. Okay, I'm back. So before we begin, can we do a quick sound check? Can you hear me? If you can hear me, if you could please just raise your hand. Just a quick sound check. If you can hear me and see me okay. Sounds good. I see that people are raising their hands. Thank you very much. Thank you, thank you, thank you. Technology disappoints sometimes, so just want to make sure we're good. Okay, thank you very much for joining me here today. Today is the 30th, and just like that, 2025 comes to an end. It's been quite a year for me, and I'm sure it's been quite a year for you. I'm just going to adjust my screen. Okay, that's much better. Okay. Yeah, so it's been quite a year, a lot of great progress with business and my personal life. And it's just been a great year. And we're very excited for 2026 as well. And as I'm sure you are as well. Hope you're having, a great holiday season with your family and loved ones. And so today's agenda is a little bit different than what I normally do. Usually we keep it very short, 30 minutes, 25 minutes maximum. Today I wanted to do a bit of a recap of 2025 from a macroeconomic point of view. Talk about how I see things and where things may go in 2026. We're definitely living in interesting times. I think we can all agree. There are a lot of strange things happening around the world in the market. COVID still seems like it was yesterday, but it's somehow we've all blocked it from our memories. No one's talking about COVID anymore, which is good. We will talk about COVID very momentarily today because it is relevant. And yeah, let's just dig right into it. People are trickling in, and we'll kick it off now. I'm going to share my screen and I'm just going to walk through everything. Today, generally speaking, I'll do the webinar, and towards the end, I'll leave a little Q&A session if you want to hang around and ask questions. I'm here. It's 6:30 p.m. where I am in Texas, in San Antonio. I'm going to share my screen, and if you can just do a quick raise of hands to tell me that you can see my screen, that would be lovely, and we'll take it from there. Okay. Can everyone see my screen? Okay. Fantastic. Here we go. Okay, so today's topic is beyond the bubble. A lot of people are claiming that we're in a bubble. We're going to talk about whether we are in a bubble or we're not in a bubble, and where things are going to go in 2026 and how it's going to affect alternative investments, especially like real estate, commercial real estate, small to medium-sized businesses, hospitality, healthcare, etc. Okay. So first and foremost, our lawyers demand that we have this slide in. So disclaimer that everything I'm discussing today is my opinion. I am not a financial advisor. I am not a CPA. I'm a student of history and I watch the market. And you should definitely talk to your CPA and your financial advisor if you want to ask these questions further, how it may impact you. We are a 506c, a Reg D company, meaning we are pursuant under the 506c Regulation D of the Securities Act under the Securities and Exchange Commission, which means our investments are open for accredited investors only. Okay, so that is the disclaimer. Let's jump right into it. This is the agenda. I'm going to talk for about 30 to 35 minutes. I'll try to keep it short and sweet. And towards the end, we'll leave a Q&A session for 5 to 10 minutes, and we'll go from there. And the agenda is as follows. We're going to talk about the past, the present, and the future. Okay? And the argument that I'm making today. Of course, I'm going to try to be as unbiased as I can. Okay? I will definitely try my best. So before we begin, in case you haven't met me, my name is Raza Khan. I am the Chief Investment Officer at Qila Capital. We are an asset management company based out of San Antonio, Texas. We have about 100. That number has to be updated. It's actually 110 million now because we acquired another hotel recently. Um, Half of our portfolio is in healthcare, the other half is in hospitality. And we're very old school people, we're very conservative people. We only like to dabble in businesses and industries that are resilient to shocks in the recession and recessions in the economy, and and industries that are backed by real demand. Okay, we're located in San Antonio, as I mentioned. Most of our properties are in the South Texas region, anything south of Austin. And this is the market that we like and we love. And we'll talk about that later, why it's so fantastic. Okay, so let's talk about the past first. Where are we? How do we get here? Okay, 2025 in a nutshell. So 2025 has been a fairly resilient year. As we all know, that President Trump is in the White House now. He's taking a lot of drastic steps to make big changes. You know, the tariffs, for example. He's pressuring the chairman of the Fed, Jerome Powell, or Jay Powell, as they call him in the industry. He's pressuring him really hard to lower the Fed rate. Um, since then, since he came into the White House, a lot of big changes have happened. We all know we're not going to talk about them in detail. This is not a political discussion. But we can all agree that a lot of drastic changes are being made, not just in the country, but also around the world. You know, some wars are ending, some wars are continuing. Energy prices have dropped. The other day I was driving by the gas station and I saw the cheapest gas price I've seen in years, $2.20 a gallon. And this is in Texas, of course. So gas prices are low, but very low, very low. And when energy prices go down, we all know that inflation goes down. The cost of food, eggs, everything, milk, everything has come down somewhat. And of course, the interest rates are also coming down. So in 2025 alone, there have been three cuts, as we know, September, October, and December. And the Fed has dropped the rate by 75 basis points, 0.75%, which is good. I mean, obviously, that's a good sign. That's the relief that we all need. The last webinar I did on a similar topic, I believe that was in October, and I was announcing the day that it happened, the Fed rate cut. So this is obviously good when the Fed rate comes down, everything comes down, inflation comes down, and the economy has a boost in activity. People start borrowing money, people start spending money, everything is cheaper all of a sudden. The cost of cars, the cost of leasing and financing a car, the cost of buying real estate, capital becomes cheaper, as we know. Okay. However, there are also some interesting things happening in the market, which makes me concerned. and makes other people concerned. And I am not a bull or a bear. And if you're not a big finance person, that means I'm not too pessimistic and I'm not too optimistic. I like to be right in the center. I believe that's the best place to be. That's where you make the most logical decisions. However, we can all agree that we've hit historic highs in 2025. Okay. There's an interesting phenomenon happening right now in the economy that there is a bit of a we can all see that there's a bit of a technology bubble happening. Nearly 50% of all market growth in 2025 in the equities market, the stock market, was led by technology and AI sectors alone. And there's a bit of a loop happening. And here I have a picture that I got from Bloomberg, which is quite interesting, that all these big tech companies are borrowing money and then they are investing borrowed money into each other. And that creates a lot of speculation. It creates a lot of hype. It creates a lot of optimism in the market. And as some of the great investors, particularly Warren Buffett, has said, be greedy when others are fearful and be fearful when others are greedy. So we can all agree that right now is a very greedy time. You may have money in the stock market. You may be thinking, oh my God, the market is doing fantastic. Why would I touch it? Just remember the old adage that be greedy, be fearful when others are greedy. And right now there's a lot of greed. Another interesting little fact for you. There are $11 trillion companies right now. A few years ago, people did not even know what $1 trillion looks like. As a matter of fact, if you ask most people in the country how many zeros are in $1 trillion, they will have a hard time answering that question. But there are $11 trillion companies, okay? Amazon, Apple, you name it. Nvidia, which is the biggest hype right now. I mean, it's a great company. They do a lot of great stuff, but it's a lot of money, $11 trillion. So the result of all of that is that the indices are trading at overinflated valuations, and they're decoupling from the reality of the true valuations, supply and demand, and what the market is actually worth. There's a lot of future speculation baked into the market numbers today. Okay. Luckily, we're not in the stock market game, or we don't have any publicly traded offerings, and we are very conservative people. We invest in real estate and businesses. So, and we'll talk about why that's a great choice momentarily. Okay, moving on. Again, so this is another, I accidentally repeated this, but here are the trillion-dollar companies that, just to give you some context. Okay, Apple, Microsoft, Saudi Aramco, which is an oil company based out of Saudi Arabia, Alphabet, Google, Amazon. And then, of course, some of them are not trillion-dollar companies. The yellow ones are Tesla, and NVIDIA is not on here, but there are. Okay. So where are we headed in 2026? That's what everyone wants to know. Okay. The good news is that real estate is a lagging indicator, and real estate has already experienced a big correction since 2022. As soon as the rates came down, or the rates went up, the market activity in real estate went down. Okay, and it's a lagging indicator, meaning that it's already experienced a correction. Now it's going through a recovery. So let's talk about the market sentiment. So the rally may continue, and instability is a theme for 2026. That's what a lot of experts are saying. I created this pitch deck. I tried to be as impartial. I did a lot of research. I looked at a lot of different, sources, and some are very bearish, some are very bullish. So we're just talking about what could happen. I'm not a predictor by any means. I don't have a crystal ball, but this is a fair assessment of where things are. There is a risk for correction, okay, specifically in tech and AI, because I showed you that loop, that investment loop, which shows that there's a bubble. However, in the grand scheme of things, the American economy is like a steam engine train. It just keeps plowing forward, and it's got so much torque. The buyer power, the purchasing power of the American consumer is really high. It's still the largest economy by a long shot. So in the grand scheme of things, we've become a lot better at dealing with bubbles than we used to be in 1999 or 2008, for example. So COVID is a great example that, that big crash happened when the pandemic was declared and the Fed, all the central banks, most of the central banks around the world, they injected money. We're still dealing with that, by the way, that side effect of all that capital injection. But we're better at it than we used to be. If there is a correction, it's not going to be a crash. At least I don't think so. Okay. I'm overall optimistic that things are going to go well. And there's a lot of great innovation happening, right? AI is changing the world. And, I'm an early adapter of AI. I've been using it since 2018 before OpenAI even came out. So there's no doubt that is going to change lives, but not to the extent of the bubble that we see today. The smart money is like Berkshire Hathaway. This is another great little example. Warren Buffett, he's beaten the market many times over, and he's, some people consider him one of the greatest investors of our generation. He's already de-risking his portfolio from tech, and he's moving it into real estate, actually, surprisingly, residential real estate. Lennar Corporation, for example, the second largest home builder in the US, he has taken out a lot of money out of Apple and he's moving it into Lennar, which tells you that, the real estate sector is slow, but the smart investors are moving their money into real estate because they know that a correction is coming in the stock market, and real estate has already experienced that correction and now it's in recovery. As the rates come down, as the interest rates come down, it's gonna rally even more. And we're talking about real estate right now. So one interesting argument that I want to make today is the Main Street businesses. That is the new frontier. Main Street America is the new frontier. So all these private equity companies, these big giants on Wall Street, they've made a lot of money speculating in the stock market and all types of asset classes. But now they're going heavily into small and medium-sized businesses, like plumbing businesses, for example, which is quite bizarre. I met a very, very lovely gentleman who is one of our new investors at Qila in our fund. Amazing guy, very humble guy, comes from a blue-collar background, built a plumbing company in the Northeast. And one thing led to another. A few years down the line, he grew his business to quite a significant size, became one of the biggest plumbing companies in his city, and he sold it to private equity for over $100 million. Okay, so that tells you how aggressive they are in buying up these boring businesses because that's where the money is made now. The boring business is where the money, a lot of wealth in this country is generated, which is one of the miracles of this country. And another example, I met a very nice dentist. He sold his dental practice to a private equity company. They have 120 dental practices in Texas alone. They raise money from Wall Street, then they buy small to medium-sized businesses. So clearly, they know something that we don't know, which is that small to medium-sized businesses are, that's the way to go. And that's where most of the wealth is generated today. Okay. So that's the new frontier. That's my argument today. That's one of the arguments that I'm making today, that that is the new frontier. And if you can get in, if you already have a business that does really well, you know what I'm talking about. Okay. So these are real assets. We're not speculating here. These are real assets. They go from a, like it says here, a narrative driven approach to a cash flow driven approach. And that's what people are realizing. That's what people are after today. And of course, they're more resilient because they're backed by real demand. Okay. Local businesses, franchise operations, etc. They cash flow. So capital is flooding in, but the specialized knowledge, the operational excellence is the differentiator. Here is a chart of the value of Wall Street relative to the value of Main Street, almost back at record highs. And these are all major trends throughout the decades. And as you can see that things are on the upswing. The QE era is a quantitative easing era. This is when the money was really cheap. and this is 2022 when they lowered the interest rate. So there's a correlation. When the interest rates drop, the economy performs really well. We've been in a bit of a limbo here, as you can see, and we're coming out of that limbo now finally because the Fed is lowering the rates. So this means my argument is that 2026 and onwards, small to medium-sized businesses, real estate sectors, they're going to perform well because real estate has already recovered. Small to medium-sized businesses are fueled by economic uh, policy, like the lowering of the Fed rate. Okay, cheap money, and that's the era that we're entering once again. Okay. Now, what if there was a way that the two worlds could come together? Small to medium-sized businesses and real estate. That is why we believe that hospitality is the best asset class in 2026. Because a hotel, a small size hotel, a select service hotel like your neighborhood Hampton Inn by Hilton it's a prime example of a franchise business that presents itself as real estate, but really it's a franchise business like a Burger King or McDonald's. You have instead of selling sandwiches or burgers, you are selling rooms by the night, and you're creating a good guest experience. But most of the bookings, just like how you drive down your neighborhood and you're hungry, you see the Golden Arches, and you decide to stop by for a Big Mac. Hopefully you don't do that because it's not that great. I mean, McDonald's, there's better choices out there. But just like how you drive by and you see a McDonald's and you decide to stop by for a sandwich, similarly, people book hotels through Marriott, through Hilton, and people are more loyal than ever when it comes to the choice of their hotel brand. Okay. Now, this is why hospitality is great because it combines the best of both worlds. It's real estate. It's underwritten like real estate. Okay. As I say here, it's a tangible hard asset and that's already undergone its price correction. When the rates were really high, when the rates were really low and the value of these hotels was really high, uh, you know, since then things have changed. The rates have gone up and the values of these hotels have come down. And that's why it's such a great opportunity for us to come to you and ask you to invest with us because we're at the, I don't want to make a definitive statement by saying that we're at the bottom, but it's plausible that we're at the bottom, and one could deduce that we've already gone through the correction and now we're in the recovery period. Okay. And then point number two, as I mentioned, these are active businesses that are drawing money from the local economy. The demand for domestic travel is not at the all-time high, but it's close to the all-time high. I think the pre-pandemic era was when people were traveling the most. That cycle, the boom cycle before 2020. And this is a great sector because it has not experienced that invasion by Wall Street yet. So all these big private equity funds have not flooded the market with money. These are still franchise businesses. Hotels are franchise businesses that are owned by normal people. They own a bunch of them sometimes, but they're normal businesses. But they carry the flag of a premium brand like a Marriott or a Hilton or a IHG. Okay. Which brings us to this point right here that it's an institutional quality asset, meaning it trades like a commodity. So just like how they say that a Toyota Camry is one of the best cars you could buy, Toyota Camry or a Ford F-150 these are the best cars you could buy because they trade like a commodity. You could close your eyes and say, if there's a Ford F-150 for sale the next state over and it's got 20,000 miles and it's a year old and it's in this color, this trim, whatever, you could almost blindly predict the price of it and it will sell because it trades like a commodity. Similarly, institutional grade hotels like this trade like a commodity because they're branded and depending on the location, depending on the number of rooms, depending on the when it was built, you could determine how much of an occupancy it'll generate. It's very consistent. Okay. So, a couple of interesting little charts that It doesn't say here, but this is 2025. This is the domestic travel spending in 2025. Leisure, business travel. $900 billion for leisure, $400 billion for business. Another interesting new trend that they're not showing here is a new phenomenon called business leisure or bleisure or bleisure, however you want to pronounce it. That's when people kind of work from home, but instead of working from home, they travel. The wife is out in the spa, the kids are playing, and the dad is in the hotel room taking a couple of Zoom calls. Then he goes out for lunch. So this is a new phenomenon that's taking place that more people are traveling and working from their laptop than ever. And this is another interesting chart. I'm going to zoom in here. Sorry if I'm hurting your eyes. But consistently, it's expected that the demand for domestic and international travel will rise. And in major cities, there is a shortage. It's a fair statement to make that there's a shortage of good, clean, respectable properties where people can stay. And that's where these branded institutional quality hotels come in. Okay. So just going to go off course just for one moment. We already talked about who we are. I'm just going to quickly go through our strategy and what makes us unique, and then we'll talk about how in 2026 you can take advantage of our opportunity. And so our philosophy, Qila Capital, our philosophy is the following. We have a proven strategy of something that works. We don't build anything. We don't buy land and try to build something on it. We don't buy or get involved with oversaturated assets like multifamily or office or anything like that. We're business people. We're entrepreneurial. So we like asset classes that perform well, that cash flow from day one. Okay. We buy something under market value, operate it right, run it right, pay our investors first. And that's the gist. That's the summary, basically. So I'll send you this deck after the call and you can look at it and have any questions, you can reach out to me. This is our leadership team. Our CEO, his name is Kuldeep Gyani, very experienced entrepreneur and operator, single-handedly built a portfolio, a multi-million-dollar portfolio, just through common sense and having a good eye for what makes money. We have our Chief Medical Officer, Dr. Pareen Shah. Dr. Pareen Shah, people ask, why do we have a Chief Medical Officer? Because half of our portfolio consists of healthcare. Okay. We have two freestanding emergency rooms in South Texas. We're in the process of building a third one in a town called Brownsville, Texas. We have an oncology practice that's being developed as we speak. We have a radiology lab imaging center that's being built. We also have a very interesting lifestyle and wellness recovery spa that's being expanded. There's one location in Laredo. We're expanding it to Austin. It's a great concept. And there's a bunch of different other asset classes, which I don't want to get into because I'm eating up a lot of time here. And then there's me. I am the Chief Investment Officer, and I come from the world of finance and asset management and fund management specifically. I'm not going to get into all our bios just because it's boring and I don't like to talk about myself. As I mentioned, half our portfolio is in healthcare, the other half is in hospitality. We have over 100 million in assets under management, and that number has changed recently. We just acquired another property about less than a month ago, 29 days ago, also in San Antonio. And these are some of the key assets: the Laredo Emergency Room, the Staybridge Suites. This is an all-star hotel in Laredo. It does over 95% occupancy on average, sometimes 98% occupancy, which is insane. Sometimes it's fully booked for days and weeks. And you may be asking why? Because we have a contract with the military they take 70 rooms in this hotel. Okay. And that's one of our strategies always. When we're buying a hotel, we want to see if we can get corporate contracts, if we can get military government contracts, because they're the best clients. They have unlimited money and they always pay their bills on time. And we have a courtyard in San Antonio, a few other assets worth mentioning. This is our newest acquisition at UTSA, University of Texas in San Antonio. This is also an A-loft and $17 million acquisition just happened very recently. And then these are some other asset classes. Okay. So let's talk about the opportunity. A lot of you may have heard me talk about this before. Some of you are new here. I don't mean to sound like a broken record, but this is absolutely a game-changing opportunity. San Antonio is the seventh most populous city in the country. It's the largest military city in the country. There are five major military bases here. It's one of the primary hubs of the Air Force and Space Force, too, I believe, if I'm not mistaken. And this property is located at the San Antonio Airport, not literally at the airport, but about a mile away from the airport, 5 minute drive, and with shuttle service. So it's a great opportunity. We're getting it at least 30% below replacement cost, which is a huge indicator of if you're getting a good deal or not. Another great metric is that we're getting it between 30 to 40% below market value. And the reason why we're getting it at such a good price is because as I mentioned earlier, there's a bit of an opening in the market right now where we're coming out of a pandemic hangover. The interest rates are very low during COVID. Now the rates went up in 2022, and now they're coming down slightly. They're cooling off, tapering off slowly. But what that means is there's a lot of CMBS debt out there. CMBS means commercial mortgage-backed securities. So it's kind of similar to how we had the mortgage-backed securities back in 2008 the subprime crisis. That was really bad because it was subprime. This is not subprime, but it's a government program where they bundle up a bunch of commercial real estate debt and they sell it as bonds to institutions. But what that means is there was a lot of greed, as I mentioned earlier. What Warren Buffett said: be fearful when others are greedy. So there was a lot of greed during when the rates were low, and people started buying hotels. They started refinancing their existing hotels, and these are non-recourse loans, meaning there's no personal guarantee. So in the world of commercial real estate, that's another great phenomenon that you can just buy an asset. As long as it generates cash flow, the bank will lend you on the value of the hotel or the whatever it is, apartment building. And they don't care about who you are. They do a little bit, but they look at the balance sheet of the hotel. So the byproduct of that, the end result of that is a lot of people over leveraged and they over borrowed, and they did it when the rates were low. And now those 3 to 5 year loan terms are coming due for renewal, which means that they are panicking and they're just giving the keys back to the bank because they cannot afford to pay the mortgage. It's too much for them. So they're just giving the keys back because there's no personal guarantee. The bank has no choice but to take it back and just auction it off or sell it off because the banks are not in the business of operating. They're in the business of just lending and borrowing money. That's what they're in the business of. So anyway, that's why this is a great opportunity. We have two different scenarios. So scenario number one is we're not going to borrow any money from the banks right now because the rates are slowly coming down. In that scenario, we're raising about 16,135,000. One thing you'll notice is there are no fees of any kind. That's one way we're changing the market. That's one way we're changing how people invest. We're not double dipping. There are no fees of any kind, which is the standard in the world of asset management and the fund management. My whole career before we founded this company, my previous mentors taught me that in the world of finance, in the world of asset management, we make money from profits and fees. So put a fee in every little place that you can. But we wanted to give a lot of value to our investors, so we completely removed it. No acquisition fees, no asset management fees, nothing. Okay. It's a pure partnership model, basically. As I mentioned, San Antonio is a fantastic place. This is the location of the A loft. This is the airport. It's a mile away, basically, and it's surrounded by amazing amenities. There's two major malls. There's a Target, and if you haven't seen it already, maybe if we've communicated already, I may have sent you a video of me actually walking through the property. If not, please message me and I will definitely share that with you. It's me actually staying at the hotel and showing people what it looks like on the inside and what the area looks like. So Let's talk about the investment options. So there are two options to invest with us. Option number one is a growth fund. The option number two is an income note. One is a 5-year option. The other one is a 2-year option. With the 5-year option, you get distributions, you get cash flow, and you get profit sharing at any liquidity event. Meaning when the value of the hotel goes up, you get a part of the capital gains. The second option is a 2-year option, which is more of an income note. There is no you could say there's no profit sharing, but you get a 10% distribution every quarter. I mean, 2.5% every quarter, but 10% annually. In the 5-year option, there's an 8% preferred distribution, plus there's profit sharing, which means that the IRR is about 13% internal rate of return, which is basically the average of all the returns over 5 years. The second option within that is if you invest more than $500,000, you get a 10% preferred distribution plus profit sharing, and the IRR is 17%. Now, one beautiful thing about us, and again, one of the ways we're changing how people invest is we're actually giving you the benefits of hotel ownership, the pride of ownership that comes with owning a hotel, which is hotel discounts. We have not factored in these discounts in any way into the return. It's all separate, okay? Everybody travels differently. Our investors get the Marriott MMP discount as long as you invest over $100,000. And that's unlimited access. You use it as much as you like. If you're a frequent traveler, you're going to save so much money that it's worth it just for the discount alone. Even if you didn't make any money from the investment, it's worth it for the discount alone, okay? To give you an example, this is a beautiful property located in California in Laguna Beach, Orange County. It's the Ritz-Carlton Laguna Niguel. Um, beautiful property overlooking the Pacific Ocean. The average rate, this was back in September, I think, when we took these screenshots. It's about $1,172 a night. Obviously, it goes up and down, but back then it was 1172. With the discount, the same hotel, same room is 281 a night. Okay. Another example, the W Hotel Times Square, 453 a night before the discount, with the discount, 257. Okay. Another example, London, the Marriott London County Hall, 552 pounds a night, 133. Actually, 613 pounds a night, River Thames view, with the discount, 133 a night. So it's almost a 75% discount, and it ranges. It goes from 70 to 80%, depending on the property that you book. Now, this is a summary of the opportunity. It's limited to accredited investors only. And if you're an accredited investor, you know, okay? Everything is done digitally. We're here to assist you, but we don't have a heavy team in terms of sales. We don't have any salespeople or anything like that. I'm one of the partners in the company. You're talking to me directly, and you do everything yourself. You sign up for the portal. We have our investment portal. You review the materials, and you verify your accreditation. You do your KYC. You sign the documents, and you fund the investment. And the day you fund your portal, your account, you start getting the distributions. The clock starts ticking, even if the money's sitting in escrow. We're expecting to close in early February, in late January, early February. And if you still get a distribution during that time. And that is the conclusion of my presentation. One thing I do want to mention is our fundraising efforts are going really well because people are realizing the value and they're seeing that the market is what it is today. It's overvalued. A lot of people are calling us all the time. I'm taking calls every day, and I hear the same story that I don't know what's going to happen in the market. I've worked way too hard to build my retirement account or build my nest egg, and I just want to put it into something more reliable. And this is that opportunity. So we've reached about 70% of our funding target with bank financing. So if you'd like to get involved, we may not have this available for too much longer. So please get in touch with us. And at this time, I will open up the floor to any questions. You will have the opportunity to either raise your hand. Actually, there's a little button at the bottom where you can press the Q&A button, and you can ask questions. And I'm happy to answer those questions for you. And please don't be shy because I love what I do, and I love answering questions. So go ahead and if you have any particular questions that I can clarify, please go ahead and type it out there. I'd be happy to explain further. Don't see any questions so far. We'll give it a minute. But I hope everyone's having a great end of the year and really reflecting on year 2025. Hope it was a good year for you. It's a great year for me. Uh, I got married not too long ago, which was amazing and exciting. I'm still getting adjusted to the married life, and but I'm very grateful. It's been a great year, and 2026 looks very exciting. So, and I hope the same goes for you, that you've had a great year. Great question. So we have a question. Is the fund limited to just this property or does it invest in multiple properties? Great question. So perhaps I should clarify that going forward and actually add it to the deck. So the opportunity is limited to this hotel. We have a very unique hybrid setup where we have one fund, and the fund is like a basket. And within the basket, there are multiple opportunities, and we allow our investors to tie their dollars to a specific opportunity within the framework of the fund. So our fund is called Qila Fortress Fund One LLC, and Qila Fortress Fund One allows us to raise up to $150 million in equity. Okay. Obviously, the total cost for this specific investment is like $16 million. So we can do five of these hotels if we wanted to, or four of these hotels if we wanted to. To answer your question, the opportunity is tied specifically to the hotel, and this is not a blind pool. Um, no, it is a specific funding for this opportunity. We will never take your money and cross-contaminate it into something else. We will always bring you opportunities that we believe will perform exceptionally well, and then you have the ability to pick and choose which option you like to go with. And even within the deal, there are two options, as I mentioned. There's a 2-year option and the 5-year option. So your paperwork will reflect that and what your distributions look like and where the money's coming from and where the money's going. Another question we have is when other opportunities come up in the future, are the amounts the same for each asset? And I believe you are referring to distributions. Um, so it's hard to say because right now there's a great opening. We're getting this property at a very good price. It's cash flowing on day one. I may have mentioned this or may not have mentioned this, but the hotel generated for almost 4.2 million in revenue in 2024. I'm still waiting for the final numbers for 2025 because obviously the year hasn't ended yet. I think by the end of the week or next week we'll have the numbers for 2025. But the cost of operating a property like this is about 2.5, 2.6 million dollars, maximum 2.7 million dollars if there's a some crazy expense which pops up. But there's more than enough cash flow for us to pay our investors the distributions that we're promising them. Okay. Um, I cannot answer that question. Every deal is different, but we're hopeful that we'll be able to deliver the same type of numbers for every deal going forward. If we're buying it expensive, then we're obviously not going to be able to. But we're buying this hotel at a very good price and it cash flows very well. So we can certainly pay an IRR of 13 to 17%, which is the average growth you are getting. And by the way, all the accounting that we've done is very conservative. If you are a finance person and you like numbers, you are happy. I'm happy to send you the breakdown of our underwriting. And you'll see that our accounting is very conservative. We have a lot of reserves baked in, so we never have to do a capital call from our investors. It's more of a under promise, over deliver scenario. Okay, so in an ideal world, we'd like to give you more. We're actually aiming to give you more money than what we're projecting. Yeah, and we have another comment here. One property versus multiple risk mitigation. Yeah, you're right. It does mitigate the risk in a blind pool, but oftentimes you'll find that people that are doing blind pools are averaging off. They have some winners and some losers, and at the end, it ends up being average. Our philosophy is slightly different. We like to scan the market continuously and find deals, really, really good deals. And if we believe that it is an exceptional deal, we'll bring it to our investors. And you know, we've crossed our T's and dotted our I's for this one. So certainly. And in the future, we'll be bringing more opportunities. So right now we're doing hospitality, but our next goal right after this acquisition of this property of the Aloft is to bring one of our ERs, our freestanding ERs, to the fund. And that'll be very, very unique because there are almost no asset managers out there that are raising money for a healthcare practice. Texas is one of the only states that allows that, like private equity ownership of a medical practice. And that will be very good because the returns on that are very high because it's insurance backed, their insurance reimbursements, and healthcare is the most bulletproof, most recession proof industry in this country. The demand is far outpaces supply, and the population is aging. There's a lot of people moving into the country, and there aren't enough providers to service that demand. So that'll be something that we're going to give our existing investors first access to. Okay. So we are running short on time. I just want to be mindful and respectful of everyone else's time because some of you are in the Eastern time zone. So I'm here. If you want to ask me questions, please proceed. If not, we will conclude the call. And what I will do is I'll drop my calendar link I will drop my calendar link in the chat. So if you want to speak to me, you can schedule a call with me directly, or you can message me and I'll call you. .com. Discovery.qilacapital.com. That is the link to my personal calendar. So if you want to speak to me, I'd be happy to get on a call with you and tell you all about what we have going on. And if you want to visit us, you're more than welcome to also. We're in San Antonio. A lot of our assets are located in South Texas, in the border on the coast, Laredo, McAllen, Brownsville. We usually fly to Laredo twice a week, Mondays and Fridays, sometimes Tuesdays and Thursdays, depending on what we have going on. But we love to take you on the road. We have a private company plane, fly out of the Bernie Airport. If you like aviation, sightseeing, or if you're feeling adventurous, come visit us and we'd love to take you out, show you what we got going on. One great question that just popped up is what are the tax implications of this deal? Is there any depreciation or write-offs? Yes, there is a depreciation factor, which is going to be passed on to the investors. 100% of the depreciation will be passed on to the investors. Obviously, it's an acquisition, a real estate acquisition, so there is a accelerated depreciation which happens, and 100% of the depreciation is passed on to the investors. There's also an upgrade that we have to do to the property because it's a franchised hotel, and just like any other franchise, you have to every 7 years you got to upgrade the furniture and the signage and the carpets and whatnot. So 100% of the upgrades that'll be done to the hotel are a write-off. It's a capital expenditure. So yes, you will be getting that in your K1. And if you're investing with your cash account, you can use that to offset your tax liability. However, I'm not a CPA. Please talk to your CPA. We do have a depreciation schedule. It's a rough schedule. Obviously, the real numbers will be determined once we have acquired the hotel. If you're really keen on knowing more about the depreciation, please get on a call with me or send me a message or email me. Excuse me. I'll also type my number in and I'd be happy to send it to you and I'd be happy to answer that in detail. Okay. And do we have any other questions? Please let me know. Okay, so just to be respectful of everyone's time, thank you very much for joining us. I wish you a very, very happy new year. And just in time, my light just went out, battery operated. So that's a cue from above. Thank you very much. Wishing you a happy new year, happy holidays, and may 2026 be a prosperous year for you and for your family. And wishing you healthy. Wishing you health, wealth, and wisdom in 2026. Thank you very much.